In this video we're tackling the very basics of what the curriculum describes as inter-corporate investments for level 2 of the CFA exam, and we're just going to very broadly discuss the categories of corporate investments or inter-corporate investments, which that categorization does determine the accounting treatment which you will be tested on. And we'll also talk about how we deal with simple financial assets that do not qualify for any sort of special treatment. So what's going to be, or what should be helpful when discussing this is this kind of axis, which is supposed to represent the percentage of ownership. Even though we here talk about assets or investments broadly, meaning both equity and debt, we really are talking more about equity, at least for now. Debt will come in, but only at a specific moment in this video, and I'll tell you when. Right, so what's very important to appreciate is that depending on a company's percentage of ownership of another company, we're talking about ownership that gives you the right to vote, so kind of voting power, which gives you influence or in some cases control. It really does depend what percentage of a company's shares you own, because we typically assume that once you cross certain thresholds, the most famous of these being 50%, you assume or you start exercising what's known as control. So to the right of 50%, obviously all the way to that ultimate 100% ownership, it is assumed that you exercise control. Now on several occasions in this video, I will talk about us assuming that control is being exercised, or that, if you don't have 50% or more than 50% ownership, you don't have control. But to be honest, it may be the case that having less than 50% gives you control as well. These are just rough guidelines, and when we discuss specific topics, because we'll have separate videos on each of these thresholds, or these bands which sit between various thresholds, I will be telling you about other criteria which we take into account other than this simple crossing 50% or not type of thing. Now, when you exercise, when one company exercises control over another business, that investor or holding company, as we often say, has itself what's known as a subsidiary. So the investee, the company into which we've invested, is our subsidiary, and that leads to a full-on consolidation in the financial statements, and we'll have videos on how that consolidation is performed. It's basically all about taking the assets and liabilities of that other business and combining them with the holding company's assets and liabilities to create a group picture or a group balance sheet. Same thing happens with the items of income and expense within P&L. They get added together, although not in that sort of very simplistic way where we just take amounts from balance sheets or income statements and we stick them together. There's quite a lot of eliminations, but also adjustments that we need to take into account under what's known as the acquisition method. We'll talk about it when we get there. Right, for now, just be aware that crossing the 50% threshold leads to an assumption of exercising control, and that means you've got yourself a subsidiary which you need to consolidate. Before we even get to the videos on consolidation, we will talk about what happens when you own between 20 and 50% of somebody else's equity, so shares, I guess, because the assumption is that you are exercising, not control, but this ownership gives you what's called in accounting significant influence, right? Which is obviously less powerful than control, but it's still, substantial, it's still important. And the company over which we have that significant influence would be called an associate of ours. That's the formal name. And you'll have to know how to apply in quite a lot of detail something called the equity method to account for associates. That's something we'll be actually tackling in the, well, we'll begin to tackle in the next video. It will take more than one video to discuss. It's quite a lot on it. And of course, down on the sort of on the left-hand side here, we've got the the 0%. And if you hold anywhere between 0 and 20% of another company's equity instruments, which I guess voting shares, we kind of say, well, this doesn't give you any no significant influence to brag about, definitely no control. I mean, it is possible that you will have significant influence without crossing the 20% threshold, or perhaps even control, but those are special cases. For now, we just deal with the very sort of rough rules of thumb that we apply here, and then we'll say, well, this is just a classic financial asset, nothing, let's say, special, not a subsidiary, not an investment in a subsidiary, not an investment in an associate, just like any other financial asset. And that's what we mean over here when I sort of wrote down financial assets. This is the bit we'll focus on in this lesson in particular. Okay, let me just say that aside from associates and subsidiaries, for which we have specific accounting treatment, there's also one additional type of relationship that comes from intercorporate investments that you need to know about. It's not as common as the other two, but we refer to it as joint control. So just like here you had control or significant influence, you could also have you can also find a relationship of joint control, and this is obviously joint between two or even sometimes more investors. So two or even more investors share control, jointly control another business. Very often we say that the company which is jointly controlled by others is actually a joint venture. So let me write this down, joint venture. Just like we had the word associate and subsidiary here, we would have joint venture. Although, for example, IFRS calls this simply a jointly controlled entity. And this equity method that we mentioned over here is also supposed to be applied to jointly controlled entities or joint ventures. We'll talk about it in the next video, although in some cases your book says it's possible to use proportionate consolidation as well, which we'll talk about in the next video too. Okay, good. So that's the landscape for what will come in the next, well, couple of videos where we'll discuss different intercorporate investments, and we'll discuss these individual methods, the method by which we consolidate, the method by which we treat associates and joint ventures. That's the equity method. But for now, let's just focus on financial assets, and these are going to be shares or indeed debt securities, debt instruments as well. And there are three approaches that you need to know to accounting for financial assets. It's FV. FV in these videos stands for fair value. Think of fair value as a synonym of market value, although technically it's not the same thing. We often think about fair value as what's the market price, okay? What's the price for which I could sell the asset in the market? Well, in an arm's length transaction between independent parties, that's fair value. So these can be measured at FV through P&L, profit and loss, and your book refers to this simply as FVPL. Alternatively, you can measure this at such assets at fair value through other comprehensive income, which your book calls FVOCI, or they can be measured at amortized cost, although this final approach is only relevant to debt securities, only available for debt instruments, not just securities, any instrument, like a loan, for example. And look, I'm not going to go through specific examples of how this is done. The level 2 curriculum in this section doesn't have numerical examples of this, of how these different approaches work, but sometimes in the questions at the back of the relevant chapter, there are questions which pick on little details from these three approaches. So I think it's a good idea to know this. I won't go through the examples simply because there is a video that walks through the details of these three methods, actually starting with amortized cost and then showing you the OCI, FV via OCI, FV via P&L treatment. That video was shot for level 1, CFA level 1, financial statements analysis, but it's very relevant to this topic as well. It's called Accounting for Financial Instruments, and I'll put a link at the bottom in the video description to that video. So if you've got the time, watch it. It's quite a long video because it contains lots of computations, just to get a refresh, or if you didn't really study this at level 1, well, do it now. It will help you out. It will help you understand what's going on. If you don't have the time, well, at level 2 you won't get asked numerical questions on this. Your curriculum doesn't feature any numerical examples on it, but it's so much easier when you know what you're being asked about. Right, now then your book proceeds to focus on the treatment for individually for debt and equity securities. And it follows the requirements of IFRS here. So kind of sometimes mentions US GAAP, but to be honest, it's all focused on a standard called IFRS 9, which is one of the most technically difficult accounting standards ever to sort of apply and understand. Okay, so let me try and do this. I used to work with these rules quite a lot in banking, so I should be able to explain it to you well, hopefully. Okay, when you've got a debt investment, right, a debt financial asset, think of a bond, for example. All right. It's a simple financial asset. Anyway, debt securities don't give you control over the business that issued them, right? It's not like equity. They shouldn't really give you significant influence either. So it's always going to be a financial asset. Now, when you're holding debt, the first thing you've got to ask yourself, and this is for the purposes of properly classifying it or categorizing it so that you know how to account for it, right, is you've got to conduct two tests. One is the business model test, and that's coupled with the second one, which is the cash flow characteristics test or characteristic test. I'm not sure if it's plural characteristics or singular characteristics, doesn't really matter. Nobody will test you on the precise name. You just need to know kind of in essence what this is. The first one is asking yourself, you are the investor, you are the holder of somebody's debt, and I want you to ask yourself, why am I, or why are we holding the debt? What's our purpose in holding somebody's debt? Now, is it perhaps because we want to collect the contractual cash flows? So we've entered this investment with the view of getting the promised cash flows on that bond or that note or whatever it is. And if that's the case, brilliant. If not, also great, but a lot will depend on how you answer that question. Did you buy this bond, or are you holding this portfolio of bonds? It's not even done at a single bond level, it's done more at the portfolio level, because you want to kind of just collect the cash flows, because that's a very different answer to perhaps I bought this bond and I don't care about receiving the next cash flows, the coupons on it, because I won't even hold it that long. I only bought it for trading purposes, or to quickly make a gain, hopefully could be a loss from some anticipated change in value. That's a very different objective from somebody who's buying the debt as a sort of proper investment and intends to hold it for a longer period of time. And the second question you've got to ask yourself is, well, those contractual cash flows which the debt is supposed to pay you, are those contractual cash flows solely, purely the payment of principal, as in somebody's repaying a borrowed amount? Think of that as the face value of a bond, or the principal on a loan, plus interest. Yeah, interest is what somebody pays you as a reward for the passage of time and the risk that you're taking, and obviously anticipated inflation and all of that. So if a bond, most bonds, normal bonds, promise to pay you a coupon, interest, plus give you back principal at the end of the period. But you can have very sort of quirky bonds, exotic bonds, like things like inverse floaters. So bonds that pay you a floating rate of interest, and a floating rate of interest is absolutely fine, it's interest, but what if it's inverse? So if the interest rate in the market is high, that bond pays you a lower coupon. If the interest rate in the market is low, that pays you a higher coupon. Well, that becomes a completely different play, because this bond, even though it pays you something which is technically called interest, that interest is computed in a way where it actually goes against the principle of compensating you for the time value of money over time, and that wouldn't classify as a bond that meets the cash flow characteristic test. Or if the coupon is on a bond or a loan is indexed to something like, something not like inflation, but let's say something more exotic, the price of some commodities in the market, or another variable, that wouldn't be your classic sort of bond which just pays you interest, a function of time and interest rates in the market, and also promises to repay principal. So with this cash flow characteristic test, as long as you've got a classic debt security paying either floating interest or fixed interest, but something that is reasonably described as interest, you've got yourself a bond that meets the criteria, but you still need to think about, why am I holding it? If the answer to those questions, both these questions, is yes, you move down in a sort of decision tree, but if any of the questions have been answered no, right, just one would be enough, we sort of shoot down here immediately and say, well, in that case, that bond should be accounted for at a fair value, with basically the balance sheet constantly reflecting what the current value of the bond is in the market, or the debt is in the market, through profit and loss, with all changes going to P&L. On the other hand, if you've answered yes to both questions, in the sense, yeah, I'm holding this bond to collect the contractual promised cash flows, that's sort of why I bought it, and yes, it's a classic bond which promises to repay principal, pay back principal, and offer some interest, then we move down here and we come to a decision point, because you may decide to, despite the bond passing the test, or despite passing these business model and cash flow characteristics test, you may still decide to designate that instrument and account for it at fair value through profit and loss. And that is your prerogative. You can do that So, you know, there's a question mark here. Do you want to designate it at fair value through profit and loss and account for it this way? If yes, you can account for it in this way, which is quite an aggressive way, quite an extreme way of accounting, because you lose control over your balance sheet and your P&L, because you'll have to update the two in line with what's happening to the fair value of the instrument, which may be going up and down. However, if you choose not to use this option, you don't want to so this is optional, right? To designate the instrument at fair value through profit loss. If not, we move down to an ending note which says, okay, then account for it at amortized cost. This is the most placid, stable way of accounting for debt securities. Or at fair value through other comprehensive income. And if you watch that video, that you'll find the link to accounting for financial instruments, I believe it's called, right, for level 1. There you will see what the difference between the two approaches is. Right, so you need to know this sort of elements of this decision tree. When you account for an instrument at fair value for profit and loss, when amortized cost is the right approach, and also when it's possible to do so at fair value through other comprehensive income. Let me also say that it's possible to make a reclassification, i.e. a change in the approach, but that change is only permitted if the business model changes. So our intention, our reason for holding specific sort of debt securities changes. So if you no longer, for example, if business model, let me just say here, if business model has changed, let me just finish the sentence, has changed, then you can do a reclassification. For example, you initially were intending to hold that portfolio of securities to collect contractual cash flows, but you now have decided that it's a better idea to start trading these things. Well, you should reclassify any instruments which you still hold from the current approach, which was amortized cost or fair value for OCI, over to fair value through profit and loss, and in the same way, or in a very similar way. If you previously didn't intend to hold a portfolio of assets for the purpose of collecting contractual cash flows, and now you've decided to do that, you should change back from fair value through P&L to, or do that reclassification to from over here to over here somewhere. And your book just says this is expected to be quite infrequent, so it's not something that you should do all the time. And if such a reclassification is indeed the appropriate thing to do, this doesn't, by the way, this doesn't work at an individual bond basis. So just because you've come to the conclusion that you don't want to hold a specific single bond until its maturity and collect all the contractual cash flows, that doesn't mean you do a reclassification. It's more a change at the business strategic level, that you've now decided to hold your entire sort of bond portfolio for a completely different reason than before. So that is expected to be quite infrequent. But if you do that reclassification, there is no restatement of previous prior periods. You just prospectively account for the instrument from now on under the changed approach. And by the way, if you're moving from amortized cost to fair value through P&L, there will typically be quite a lot of gain or loss that hasn't transpired in the balance sheet, in the sense that the carrying amount at amortized cost is different to fair value. So you'll have to do a one-time adjustment, which will be either a gain or a loss that will go to P&L as a one-time effect. Okay, now That was the accounting for debt. What about equity, financial assets? Let me emphasize again that we're talking about relatively small investments into somebody else's equity holding less than 20%, so we're by no means crossing that 20% threshold, which would get us into associate or significant influence territory. Well, with equity, you've got to ask yourself the question, once again, why am I holding this? Is this security held for trading purposes? And if it is, if the answer to that is yes, well, the standards say, let's take it, let's measure it at fair value through, sorry, that's not a very good spelling of through P&L. So basically FVPL, as we typically abbreviate it. Now, if you're not holding somebody else's share as trading securities, you're not buying, selling constantly. You now have to ask yourself, do I want to designate, and this is once again an option, right, that you have to decide on. Do I want it to be designated at fair value through other comprehensive income? So that's where you'll be updating the value of that equity security in your balance sheet to its current fair value. So the carrying amount should always match the fair value, the market price ideally. But any changes from one period to the next in that value will not go to P&L, they will go to other comprehensive income. And it's possible that you'll answer that question, no. Okay, I'm not holding the instrument for trading, but I don't want to designate it to be measured at fair value for OCI. So then you will account for that equity security in the same way as you would for one that was held for trading purposes via P&L, with all the changes in value going to P&L. However, if you want to, this is a choice, you can answer yes to this question, in which case the instrument will be accounted at fair value, but with all changes in value going to your other comprehensive income, which means bypassing your P&L. Take a look at that video, which I mentioned already twice. You'll see what that means. Although that instrument, that video has examples sort of which are debt specific, same principle applies to equity as well. However, this choice is irrevocable. So let me say choice is irrevocable. In other words, you cannot change it. So there is no reclassification permitted. At least for equity instruments. And if you've decided to follow this approach, the only thing that will go to your P&L will be dividends received. So only dividend income is recognized in P&L. Recognized in P&L because the fair value changes up or down, they go to OCI, other comprehensive income, as opposed to P&L, whereas under this approach on the left hand side, through fair value, through profit and loss, everything goes to P&L, the total return, the change in value, and any income received on the security. The same thing happens with bonds. Now, so only dividend income is recognized in P&L, not those fair value changes. Okay, well, as I said at the top, the book doesn't feature any numerical examples of this. Although it is a highly technical topic, please watch that video. If you're not hugely short of time, watch the video that's referenced in the description, and see you in the next one where we discuss associates. And, well, equity method, that's the topic of the next video, which is relevant to associates, but also to joint ventures.